When it comes to housing, it's a big, big worry for market legend Jim Stack, who tells me, and keep in mind, Jim was the same guy who back in 2004, 2005 was worried about a runaway real estate market. Well, he's worrying again. Take a look.
I think the risk to the housing market, if prices are overinflated or getting overinflated, as we think, is that in an economic slowdown, and if interest rates are a half or a full percentage point higher than they are today, then those housing prices could come down a notch or two, and possibly more if we go into an actual recession.
All right. What are the odds of that, and what are the odds this market can sustain itself the way it has been of late?
I think it's pretty much a certainty at some point, at least within the next 2 to 4 years, we have to look at the prospect of a recession.
All right. Now, you can quibble with that. Now, of course, he was predicting the last housing market crash. He's not necessarily saying it would be an outright crash, but that we've run very far, very fast, and that we're due for this, and that it could drag the market down with it when it occurs. Now, housing expert Senada Adzem is here. We've also got market watcher Joe Duran. Senada, to you first. What he's saying is some of the incentives to own homes have been taken away, ironically, with this tax cut package. People in high-tax states have very little interest in it. And so the underpinnings for housing, despite the improving economy, despite all that extra dough Americans are getting their hand on, it's not going to pan out. He's worried. Are you?
I'm not worried. The reason is because the fundamentals are very strong right now in the housing market. I've been in Florida for 15 years right now, and what I can tell you is that people are feeling very, very confident. The economy is very strong, and they have a lot more purchasing power. So it's not just the numbers, it's also the perception of the buyers, and they're very confident right now, and their sentiment is very positive.
What do you think, Joe?
I think that the housing market is now, because of the tax bill, a lot more regional than it's ever been. As you correctly identified, in states like California and New York, the affordability, which was already out of reach, is now even more out of reach. States like Florida and Texas are going to see influx of population, and the cost of owning a home isn't what it is here in California. The second thing is, it appears that we're following Bush's doctrine of a lower dollar. We talk it up, but we let it go down. That means more capital investment from the rest of the world. That will also be a support for real estate. What happens, unfortunately, is if you have too much foreign money coming into our assets, makes it even less affordable. So I think I'm maybe less optimistic. I agree this is the most business-friendly president we've had in a very long time. That is making people wealthier. The stock market's making people wealthier, but it's about affordability.
You know, Senada, one of the things that he mentioned is that not that we're getting sort of dangers again and going back to that period in the late 90s, early 2000s where anyone with a pulse got a mortgage, no doc loans and all of that, but risky loans are coming back again. Not again in the numbers they were, but enough that it concerns him and that it is propping up real estate in some key locales. What do you think of that?
Well, in 2007, we had some very predatory lending practices, and I don't see that right now. In the past, you had people who were getting mortgages that they couldn't afford. You had hairstylists who were buying $2 million properties that they couldn't really support. What I'm seeing right now is that properties that are going and they're selling very briskly are the ones that are valued right. So people who are buyers are very sophisticated. They sobered up after that crash in 2007, and they're spending the money, but they're spending it wisely. All my clients, they want values, and they will not pay over the market value. They're very cautious, of course, but they feel much stronger fundamentals because the banks are no longer offering subprime mortgages. They're no longer lending to people who cannot afford those mortgages. So those are the two most important fundamental shifts, and they actually came as a regulatory change in the aftermath
So that would support the
recession.
markets. If she's right, Joe, and I have no reason to believe she's not, but one of the things that you could argue in the extreme case is, let's say Jim Stack is right. Maybe housing, though, isn't the leader it was or the influencer, pardon the term, that it was, and that there are other things that come to the fore here that help the economy, and this time without housing. What do you make of that?
I totally agree with your view, which is, first, I don't know if it is your view, but I do think
It
that
is,
real
which is
estate today
dangerous.
is not
It's
what it
extremely
was.
dangerous. Yeah.
Well, the one thing I know is that we don't have the supply of capital issue that we had in the past, that were very loose lending standards. The banks are really well capitalized now. What led last decline was two things happened. Pricing became completely untenable, and the banks were unable to support it. We don't have the bank problem now. We have certain markets that are frothier, some that are fine. We have offsetting stock market appreciation, offsetting increases in income. So in general, I'd say it's unlikely and almost impossible to go back where we were 2007, 2008. I think you're very likely to see the markets flatline, or certain markets come down a little. But frankly, we've had a very good run here, 10 years of very, very good markets in every place. So it would be normal. So the panic mode, it's unimaginable to me that we could ever go back to 2007, 2008. We don't have the speculative lending we had in the past.